All right, let's stay with company reports. Cash converters seeing revenues rise by nearly a quarter to more than $115 million, but lease costs continuing to weigh on the company, given COVID's impact on physical retail stores. For more, Sam Budiselik joining us from Cash Converters. Sam, good to catch up with you again. So, do you feel as though you've got past COVID, although that's still obviously weighing on your results at this point?
Yeah, thank you for having me on the show. Look, our first half was the most heavily COVID impacted half that we've had yet through this pandemic, and like many retailers, we lost a number of our store trading days. Over 24% of available store trading days were lost. So our store network through that first quarter was largely shut down in New South Wales and Victoria. Yet, as we've come out of this lockdown period, we've posted strong revenue growth, as you mentioned, up 23%, and our underlying profit growth was really strong at $7.7 million NPAT. I think, unlike other retailers, with our stores being our supply chain, as we procure inventory and meet our customers in store, obviously struggled through that first half, but we're looking forward to that changing in the second half. And online assets have performed really well, and our loan books have grown as a result.
Yeah, talk to us a little bit more detail about your loan originations, where they are coming from, where the momentum is headed.
We grew our online presence about 10% off a pretty strong baseline that had increased through COVID. We've got about 65% of our outgoings going online at the moment, which is up from a normal sort of 50% level. So online assets are stepping into the void that's left with the store closures. But as the stores come back online, we expect that to normalise somewhat, but we've invested heavily in that digital platform to ensure we can be there, for our customers online. And we've also shifted our profile to a longer term, lower cost focus. So we've seen that loan book double over the 12 months, and our overall loan book grow about 23% over the year, even with these distribution challenges that we've got as the online assets serve more of our customers.
Mm-hmm. How about bad debts?
Yeah, we've got a strong credit profile. We've been conservative coming back into our markets. I think we've got quality growth. Our bad debt rate is sitting at a normal level, slightly lower than entering into this period. But we're aware that people are in an unusual environment with high savings levels, and there's been a fair bit of stimulus coming through the market. And I think the second-hand vehicle market's a good example of really elevated second-hand car prices that we don't expect to continue into the years ahead. We would expect that to normalise. So when we're assessing the credit risk and the profile of our consumers, we're being very careful. We're only approving around 20% of the applications that we receive, which can exceed 40,000 applications a month. So we're responsibly entering back into the market, making sure people are well set when they're coming to see us, and hopefully meeting those needs in a better, longer term, lower cost way.
And Sam, you've outlined a new phase of inorganic growth. What sort of acquisitions are you looking at?
Yeah, I think a testament to our underlying financial strength was the declaration of another dividend. And we've also got $64 million of cash on our balance sheet. It puts us in a really strong position to consider inorganic opportunities. They'll be aligned to our core segments. We're looking at assets and businesses that complement our existing Cash Converters platform and customer set. And we've got a number of opportunities under evaluation, but we'll need to meet some pretty stringent hurdles and assessment criteria in order to proceed. But we're in a really strong position in terms of cash and balance sheet. So we look forward to growing the company now that we've sort of stabilised through the COVID period at a greater rate.